All right. Hey, everyone. We're live, and this is the Real Estate Investing War Room Live. I am here with Brian Bigham today. He is the cost seg cowboy. Brian and I have actually worked together on a number of real estate deals, and he has saved me and our investors a ton of money through tax depreciation strategies, cost segregation studies, and a number of other things. In addition to just being like a crazy wizard smart with all the stuff that he does, he's just a good guy to know and helpful for any real estate deal. So I appreciate you coming on, Brian. And yeah, I'd love to hear your story.
Yeah, thanks for having me, man. A lot of people actually ask me, how did I get into this specific niche, cost segregation, real estate taxes, and the one thing, basically the things I can talk about to put people to sleep, really, when it comes to taxes and whatnot. But I've been in commercial real estate in some form or fashion for 20 years. I know I don't have much gray, but yeah, it's I've been doing, whether it's management, brokerage, subleasing, sales, anything involving real estate in general. Like, I've done it. And my company that I work with, Madison Specs, the spec stands for Specialized Property Engineering and Cost Segregation. I actually joined up with them when they opened their new office here in Dallas, Texas. And they said, hey, we would love for you to run our cost segregation wing here in Dallas. First thing I said was, great. What is cost segregation? No idea what that is. I've been in real estate for 20 years, and I didn't know what cost segregation was. I knew what depreciation was, but did not know what that was. So, once I actually learned about it and read about it and watched some videos, read some articles, it occurred to me that I've been, honestly, for a better lack of the word, stupid when it comes to feeling like I had to pay taxes on every, dollar I made from my real estate journey. And now it's come to that time where it's just the most joy in the entire world, telling like the story on how to do it with everybody else in the world that has to pay taxes. So
Yeah, absolutely. So I'd love to kind of hear your story of like, how did you make the transition into cost segregation? How many, what kind of deals are you working on? How many people do you help save taxes on? And then, in addition to that, I'd love to hear your story on just real estate investing in general, and, more about what is a cost segregation, because a lot of people don't know. So yeah, I kind of love to hear all those details.
Well, where do you want to start?
I guess let's start with your story. What's your journey like doing, you said 20 years in real estate. What did that look like before you got into doing these?
Oh yeah. So when I graduated from college, I went to Texas Tech University. When I graduated, the student loans started calling, and as they well do. And so essentially, rather than defer them, I decided just take some work in commercial real estate, and I started working for some like subleasing office space, and it was immediately I was hooked. I was meeting different people, in different forms of life, and everybody had different businesses. They were trying to, start and just make money. And I love doing it so much that I decided to, go a little bit further, and I got my brokerage license and did some residential, brokerage, and that was fun. But as many of you well know, it's hard. It's hard when you get started with it. So after trying to do that full time, I did it a little bit on a part-time level, and then I went back into commercial real estate, and I started doing management, like office retail management sides. Did that for a couple years and decided that it was a grind, and I was starting a family. I've got a beautiful wife and two boys now, and after that, I just started looking around, and just lo and behold, came across Madison Commercial Real Estate. And Madison Commercial Real Estate, that's kind of where we got it. I joined up, learned about cost segregation, never looked back. I love what I do. So in general, with cost segregation, a lot of people are like, what is that? It's a kind of a terrible name. The best way that I always like to say it's accelerated depreciation, or another way of saying it's kind of getting an interest-free loan on a commercial property you've already bought. That's kind of cool. But really, if you're familiar with depreciation in general, depreciation essentially is you buy a property, your purchase price, you take out the land value. Land is always going to be there. If a tornado came and knocked the building down, what's left? So
Mm-hmm.
once you take that land value out, you're left with a depreciable basis. So that basis right there is how much if depreciation or losses from the physical assets that you're going to get over a very long period of time. So it's if you're buying like a residential property, multifamily, single family, assisted living houses, that kind of thing, then it depreciates over a course of 27 and a half years. So the reason I say that is because you take that original depreciable basis and you divide it by 27.5, and that's what you get in depreciation and losses towards that property every single year. Doesn't make any difference. That's all you get. It sounds like a lot, but in all honesty, you can put improvements in, you can force the appreciation, you can add curb appeal to that property, increase the rents, increase the value, everything. You're not going to get more than that single small piece of straight line depreciation. So in 1987, actually, that's how far back it goes. What was I doing in 87? I can't even remember. I was still in elementary school. But in 1987, the government put into practice something called cost segregation. And what that basically did was it allows everyone to identify physical assets on every single property that have a life expectancy associated to them. Meaning, instead of depreciating an entire building with everything inside of it and everything on the outside of it over 27 and a half years, you've got things like ceiling fans and carpeting and appliances, cabinetry, baseboards, things that are, you shouldn't have to wait 30 years to get that loss. So they actually put it into a bucket of depreciation called 5-year assets. That 5-year assets, by doing that, you're not averaging it out over 28 years anymore. You're taking it years 1 through 5. The year you place that property into service until the 5th year out. You take all of that up front. And then you've got your other categories like 15-year assets. Those are exterior land improvements. And that's things added to the land that the property sits on, but not necessarily part of the structure. Things like fences or pools or monument signs, driveways, landscaping, even. I mean, those they have to be given a little bit longer life because they were added to the exterior side. So they give them 15 years. So they depreciate over years 1 through 15. And then, of course, the remainder, the 27 and a half year or the structural component, windows, walls, roof, foundation, things that actually make the structure of the building, not necessarily the curb appeal of it, that stays consistent years 1 through 27 and a half. So in retrospect, by doing cost segregation on it, instead of averaging, everything out over 27 and a half years, you're essentially doubling or tripling the amount of depreciation years 1 through 5. So that's the key. What would you rather have? More losses to stockpile and use, to offset just about all the income, or all right, I'll pay my taxes. Here you go. So.
Absolutely. Yeah. And I know I personally have benefited from this quite a bit. And to your point, if you have all this depreciation and it's going to come over the course of 27 and a half years, but you're able to just take more of it up front and front load a lot of it,
Yep.
It can oftentimes be so much that it's the amount that you would have normally gained from the income from the property, maybe even more. So in essence, you're offsetting the income that the property is generating for you from these depreciation losses, early on. So I'd be curious, if you kind of have any kind of a range or numbers, like let's say somebody's buying a typical property, it's whether it's a house or a multifamily property, that's like $1 million. I know every deal's a little bit different, but what should people expect with normal depreciation versus this cost segregation?
Well, so the funny thing is, it's when it comes to the actual property itself, a lot of people think it's only big commercial real estate. It's only like giant multifamily properties, apartment buildings, or skyscrapers, things like that. I've the one of the last single family rentals, just a single house that I did, the client bought it for $150,000. We did cost segregation. It actually made sense for them. They didn't want to pay any taxes at all. We did cost segregation on it, and we ended up finding about 38% of that 150K. There was no land value associated to it. So
Mm,
150K, that much they were able to move forward. It fell under the lines, which I'll talk about in a second. Bonus depreciation, 100% bonus depreciation. It fell in that window. So they were able to take all of that in 20. They did it in 2022, but they ended up doing it in 2023. They took it all for their 2023 taxes. So they're not going to pay any income taxes on that property, and they have about 20,000 left over to roll over to the next year.
mm, mhm,
The key is, like when I say stockpile before, it's if you don't use it, it stays with you. You roll it forward. It's not
mhm.
a use it or lose it scenario.
Yeah. So what you're saying is somebody bought a house for $150,000 and they probably got a loan, right? Did they, they probably put
Yeah.
20% down, maybe 25% down, but they were able to get, did you say 38% of
Oh
that
yeah.
150,000 as a depreciation? So they got whatever number that is, like 58, $60,000
That's right.
depreciation write off, and they probably only put 30 to 40,000 down. So they got a bigger write off than they even used as their investment into the deal. Is that right?
That's absolutely right. And that's something a lot of people don't think about is, they say, hey, I only put 20% down, to buy this house. That has nothing to do with it. It has to do with how much the total purchase price is, including the loan. So your down payment plus your loan, and even technically your closing cost, you can work into that. So I mean, it's a big number once you think of those percentages.
Yeah, and that offsets, I mean, obviously that's the money you're putting towards it, but that's a big write-off that can go towards a lot of things. Obviously, like you said, you could carry it forward, but let's say somebody sold some stock in order to purchase this house or maybe did some other income generating activities, that income could offset, or sorry, that depreciation could offset the other income that they have coming in.
Yeah. So think of it like this. That brings us to another point. We can get really into the details now. Now that we're like 12 and a half minutes in, now we're going to get to the nitty gritty of it. So when you do depreciation is passive losses. Passive losses offset passive gains, meaning that even if you're making money from one property and that's rental income, you can do cost segregation on it. You can offset the income that you're making from that, so it offsets that income. Plus, if you have, let's say, income from another property that's coming in, you don't have to do cost seg on that property. You can actually utilize the same depreciation that you received from this property A and offset property B as well without having to do anything else. The key becomes, and this is where I like to call it tax strategy. And before we start, always consult your CPA with this, everybody.
Mhm.
But whenever you qualify for certain standards when it comes to in your tax strategy and your taxable income levels, you do have the ability to use this depreciation to offset not only rental income and passive income, but also active income, W-2s, 1099s, gains like capital gains, that kind of thing. And that's something that we call REP in the business. REP. It's real estate professional status, active real estate professional status. So
Well,
go
yeah,
ahead.
yeah, go ahead.
I was just gonna say, you want me to? I'll just keep going on and on and on unless you stop me. But um, but being an active real estate professional, a lot of people ask me like, how do I am that? I own a property over here. I'm like, okay, it's not about the property owning. It's not about how much money you make. I mean, the IRS obviously knows or legally knows how much money you make.
Mhm.
The key becomes how much time you spend. It's all about time with them. So, in order to become an active real estate professional, you have to meet two qualifications. Number one, you have to have 750 hours a calendar year involving real estate. And that could be anything from closing, trading, managing, maintaining, that kind of thing. As long as you have it documented where you've got those 750 hours involving real estate, that counts as the first qualification. The second one is time of percentage wise, 50% or more of your business involving real estate. And that's, again, whether it's managing, maintaining entity, arranging, or even education. Technically, if you guys are watching this and you document it, we'll try to go as long as we can, but you can put that on your
Yeah, this might be one of the 750 hours we can get through right
there
here.
you go.
Excellent.
There you go.
So I know a lot of the clients that invest with us or that are watching this are either realtors or mortgage loan officers. So
Mhm.
I wonder if you shed some light on, let's say they get their real estate business is commission income from closing deals, but they don't necessarily own any real estate, but they might be a limited partner on one of our deals or one of these commercial deals, or maybe they just buying their first investment property and they do a cost seg study. Can shed some light on like what's their qualification on real estate status?
So I'll throw you one better. I'll use kind of like my own personal example. I've been doing real estate for 20 plus years. I do exclusively cost segregation right now in the real estate world. That's my job. Even though I'm doing this, like this is my full-time job, my job actually does not qualify me as an active real estate professional. My time that I spent doing, I'd probably do 1 or 2 hours of underwriting a night. I go speak at educational seminars and I get up on stage and actually present on real estate strategies. All the times that I'm doing that actually qualifies me because it's
Mm,
in the real estate business. It's
mhm,
moving and shaking. If you are a broker, just being a broker will not actually qualify you, but the time spent working on real estate level activities will qualify you. Things like if you are closing a transaction, the time spent on closing it, underwriting it, transitioning, working on marketing for it, those kinds of things, those are the things that will qualify you.
mhm. Excellent. No, that's good to know. And I
Sure.
mean, it can be very beneficial to have that status versus not. So, and I think you can elaborate on this a little bit is that if you have real estate professional status, it goes against active income and really like all income, not just the passive kind.
That's right. I'll tell you, just without sounding too mean about it, the air is much better up here, guys. As an active real estate professional, any losses that you attribute to real estate in general can apply to everything. There's no longer passive losses, passive gains. There's no longer active losses, active gains. Everything is literally brought together and made active only. So I can get passive depreciation from a rental property that I've purchased, and I can apply that to my W-2 for Madison Specs. If I sold a property today and I had a capital gains hit, I can offset that capital gains hit with money I made from a garage sale and a loss I made from a garage sale or something. So
Yeah. Yeah.
it's all about documentation. It's all about status involving how you're categorized with your accountant, your CPA. That's the biggest thing. I always say it. Ask your CPA if it makes sense and if you qualify.
Well, and I'll tell you as well. So I am a real estate professional. I have a little bit of personal time that I use during the year, but almost all of my time goes towards real estate activities. I'm a fan of what the power of real estate can do for individuals and just everybody out there. So in 2022, for example, when we had 100% bonus depreciation, I was a partner on 5 deals, and you did the cost segregation on most of those. I want to say, if not, a majority of them for sure. And I was able to write off something like $400,000 or so on my
Excellent.
tax returns because of all of these. Now, at some point when we sell these, we'll have to come back and talk about recapture. But I didn't pay any taxes to the IRS on my 22 returns. I actually had a loss of like 200 something $1,000, which means I could have still had $200,000 of income somewhere else and still paid 0 taxes, which is just
All right.
incredible. Like a majority of people in real estate like get away with either not paying taxes or substantially lower than most other people.
That's right. And you make it sound like it's just too good to be true. I mean, this is outstanding. But in all honesty, it's what you're getting, that $400,000 of losses. It's just on paper only, and that's
Mhm.
that's what the IRS is doing. They know how much you're making. Papers coming through from your job, from your real estate world, everything. They become paper losses of depreciation, and that paper loss will actually apply to your overall gains that you're making, that income that you're making from that property. And it just becomes so powerful. And it's 100% legal across the board. The IRS actually put in the audit techniques guide in their website, cost segregation audit techniques guide. It's pages and pages of ways to explain to people, this is what you need to do when you own real estate. They want you to use this strategy. They just don't talk about it.
Well, and to your point about this just being a paper loss, we were still getting income. I was still having money going into my bank account, and it was legal. And but to the IRS on paper, it was a loss. So yeah, very much a powerful strategy. But I do want to talk about the flip side of this. I post on my Facebook about some of the deals that we do and some of the depreciation that we receive. I want to spread the word and the education just like you're doing here. And so
Absolutely.
a lot of the questions or feedback I do get is about that recapture. So, let's say we buy a property and maybe we, own it 5 years and sell it, or maybe we own it 30 years and sell it. What happens when, we do sell it?
See, and there's basically 100 different answers for you on it. But this is something I get asked a lot when I'm up on stage as well. So one of the big things that people don't realize, and it's always like a game changer for them, is when you go to sell a property, you owe what's called recapture, depreciation recapture on the sale. And what that means, if you go back just a little bit, is when you take depreciation, what it's doing is, again, it's lowering your basis in the property. Your depreciable basis is now lowered from when you bought it to when you sold it, which means when you sell it for a profit, it's going to be a much higher margin, which means you're going to owe more on the gains. So one thing that I'm constantly explaining is people think that when they take that massive amount of depreciation, when they go to sell, they're going to have to pay it all back. But it's actually stated, and it's written right there on the IRS side, that when you go to sell a property, you owe a maximum, a ceiling, a cap at 25% from the recapture. 25%. Now, one thing you have to understand is that 25%, because your recapture, your gains, depreciation recapture is taxed at ordinary income tax rate. So if let's say you're at a 35% tax rate right now, you're not going to pay 35% on the gains. You're going to pay a maximum of 25%. It's capped. So here's the, after all that, I'll break the bombshell to you. Here's the fun part. Because it's taxed at ordinary income tax rates. Think about having more than one property, just like you, Ryan. You have more than one property involved. The concept of this is, the more depreciation, the more losses, the more paper losses that you're applying, showing that your tax rate, you're lowering your tax rate further and further and further down. When you go to sell that property and you have that 25%, ordinary income tax rate, what if your ordinary income tax rate is nothing? Like it's zero. Like what if you're at that 14, like 16%? That's what you pay now. You're no longer 25%. That's only maxed out because for the high income, high net worth earners. On paper, you are a much lower tax bracket, so you actually will pay much lower on the sale. A lot of people know that. It's all numbers.
It really is. It really is. So I have an interesting situation that I think we ran by you a year ago. So let's say there was this guy that had this, multi-million-dollar property and he wanted to sell it, and we could buy it with bank financing, and he owned it free and clear at that point. It had been depreciated all the way out. So he was going to have to pay capital gains on the whole thing. And we had offered to say, hey, what if we bought it with seller financing, where he pays, capital gains on maybe the first 20% up front when we do the down payment, but then the rest is kind of structured out with payments over time. And I guess, I know this is a little bit outside of cost segregation, but there's some benefit, especially with people nowadays and where interest rates are and where sales prices are, with, hey, maybe seller financing is a good way if you are ready to retire and liquidate your asset, and maybe do a cost segregation study on a different property or something. And, I don't know if you've had that come up recently with seller financing.
Believe it or not, I have, on more ways than one. I've had that on people that are purchasing a property with seller financing. It's actually it's bringing up a few stories. So I've actually, and it's a fantastic way of doing it. Number one, I've actually tried doing it myself on a few properties on my own because these rates nowadays are ridiculous. So anytime you can get seller financing on the rates that they currently have, take it if you can. The other side is I had a gentleman approach me and say, "Hey, Brian, I'm putting down, I'm best and final on this deal, and it's going to be seller financing. Can you do me a favor? I've been trying to explain to this gentleman. He's worried about selling, and he's going to owe all those taxes. Can you talk to him?" He wanted me to talk to the seller. I ended up talking to him and strategizing with him, and it turned out that it just made super amounts of sense for him to do a seller financing and actually put a portion of his gains into the syndication that's buying the property. It was like a complete flip, and they're just kicking butt on this one right now. I think it's returning something in 12% range. I don't know. It's insane. I might have put some capital in it.
I mean, yeah, when you see a good deal, it's hard not to.
Absolutely. But it's little things like that. The tax incentives, the tax strategies that actually in the scheme of things play the biggest role over a year's planning. It's not just, month to month to month. It's not just like 1 year. What's the returns 1 year? You're literally planning out 5, 6, a decade in advance on how to earn the most and pay the least.
Yeah, absolutely. No, well said. Well said. So I'm curious, I know a lot of people are going to ask, it sounds like cost segregation is like this great thing. How come I haven't heard about it before? Is it just good in every situation? Are there like, sometimes situations where it's not really worth doing or it'd be a bad thing to do?
There is, and that's something I'd like to pride myself. I'm fully transparent with everyone that I work with. If it makes sense, do it. If it doesn't, then don't do it. Plain and simple. I mean, if it puts a dent in your tax return that you don't want to pay, then let's consider it. If it's for like a syndication or a multifamily syndication, something like that, it almost always makes sense to do it just because every single person involved, every person that's putting skin in the game, investing their capital, gets a piece of not only the returns but also the depreciation. Everybody gets it. But when does it really not make sense? It really comes down to if you're there's a few things. If you buy a property like a fix and flipper or a wholesale, if you're going to buy a property and sell it within 12 months, don't do cost segregation. You're not going to see the benefits, and your basis is going to be dropped tremendously, and you're going to have more money. You're going to owe more money on the sale than you were actually making. So I wouldn't do it if it's a quick fix and flip.
Mm-hmm.
If you're investing through like an IRA or a 401k or something, some kind of tax-free investing entity level, why would you do cost saving? It's not going to benefit you. That's a big one right there. But actually, there is one this might like break a few skulls. When you do cost segregation and you get all the paper losses and everything, I have been having a few people tell me that it's actually a little bit more difficult to get the big bank loans like on future properties because their income is so low. The banks aren't even taking a second look at the details of it. They're just saying, "Oh, you only made like $5,000 last year. You own how many?" They don't even ask you how many properties you own, how much income you're actually making. They just see the losses, the total income, the adjusted gross income. So I always say is like if you ever run into that, then reach out to a couple of lenders or possible mortgage brokers. They know how to work it, and they can get you the best ones. People that actually look at the details to help.
Yeah, I'll agree with there. I used to be a mortgage loan officer on the residential side, and I'm sure commercial has their own rules. But yeah, the rules say that you are allowed to add back in depreciation because it's just a paper write-off. It's not a real loss. So
Right.
it still shows as profitable. But it can be alarming if you're not a good loan officer or not very detailed to look at that
Exactly.
first page of the 1040 and say, oh, there's a zero or a negative number here, or not very much, and not really go all the way to the Schedule E when you see how much was depreciation, how much was losses. And I also say, it can even be more difficult in the commercial world if you've invested in a syndication. All the syndication will give you is the K1 that you qualify for with part of your LP investment.
That's right.
And so when you have a loss on a K1, it doesn't really show apparently whether that was from depreciation or from just ordinary losses as well. And so if you wanted to say, hey, this was depreciation, you would actually have to reach out to the sponsor, get the partnership 1065 tax returns where it does show the depreciation loss, and then you could give that to your loan officer, and then they should be able to add it back in. So there are a lot of steps in there, and hopefully you work with a good loan officer that can do that. But yeah, to your point, it adds a lot of complexity if you are trying to get bank financing for buying more real estate.
Absolutely, absolutely. Those are just some of the few, but I mean, outside of that, it's just so powerful to use when you can actually utilize it for the ultimate goal of retiring early.
Absolutely. So do you have any stories of like some of the best case scenarios where you're like, hey, this one person came to me and they just knocked it out of the park?
Oh, for sure. I mean, oh my gosh, it's all based. A few of the stories are on different assets. I mean, you've got one gentleman that I've worked with. He came in, and actually he didn't come in. I met him at a conference, and he didn't know what cost segregation was either. After talking to him a while, I found out that he had just recently bought his 8th multifamily property out in West Texas, and I asked, I was like, "Are what are you a syndicator? Are you do?" He said, "Yeah, I have partners and I have syndicate, investors, a really good string of investors, and they put their money in. He's like, it's better than the stock market." I'm like, okay, well, what's so you guys are doing cost segregation, you're doing depreciation, everything. He's like, no, we're doing depreciation, but I just let my CPA take care of that. I'm like, okay. So randomly asked him, so what are you paying in taxes every year? He's like, oh, I don't know, six figures. I mean, a couple of years I've had 7 figures taxes, and I put my hand on my face and just was like, oh my God. He still to this day has not given me a CPA's name, but ultimately I told him, I talked to him about it, and he let me have a shot on the last one he bought.
Mm-hmm.
And after I did the cost segregation for him, he was getting about 900,000 of depreciation, just the way he was doing it. But that 900,000 was spread between 3 partners and about 15 or 16 big investors. So ultimately, he was getting maybe 5 figures of depreciation to offset 6 figures of income.
Mm-hmm.
Once I did that, we found about 35%, and it gave him about $9 million of depreciation.
Oh my gosh.
That he was able to use that year that he closed.
Yeah. Wow.
Needless to say, he said, "Hey, Brian, I've got 7 other properties that I've bought over the years. I'd like you to take a look at." So, yeah, he's a great client, and that's one of the things that was when I was first getting started in cost segregation. But one of the other things I think we kind of been touching on it, Ryan, but I haven't dug real into it, is bonus depreciation.
Mm-hmm. I was just about to ask. Yeah, and it's a tricky term. So yeah, tell us all about what that is and what's going on in the world these days.
So going back to a little bit earlier, I was talking about cost segregation was started in 1987. It's been around since 1987. It's still going strong, but it wasn't until 2017 that it really hit the map. And the reason why is because the former president, Trump administration, instituted the Tax Cuts and Jobs Act of 2017. After many different, tax incentives brought down, one of the biggest ones was called bonus depreciation. And in another way of saying it, it is cost segregation on steroids.
Mm-hmm.
What it's basically telling everyone is any commercial property and commercial real estate property, which means if it's a real estate that's making $1 of income, right, you have the ability to take any assets under a 20-year life. So if you remember earlier, I was saying 5-year property, 15-year property, 27 and a half year property. If it's under a 20-year life, which is all that 5-year, all that 15 years. So when we say percentages like 35%, 38%, 50%, you can take that amount of money the year that you place that property into service or the year that you acquire it, the acquisition. Quite literally, all of that in the first year. And that's the ideal definition of that's how you stockpile losses. You've seen it, Ryan, on your K1s. When you go to close a property, when you get your K1s, you get your returns. First year is usually prorated, so it's a little bit less, but that depreciation number is really high. That bonus depreciation is they just syndicators, GPs, they lump it in, they put it all in to your K1. So as a passive investor, as an LP, you've got all these losses and they're staying with you. They're suspended losses. And those suspended losses can be used on that income, possibly other income, depending on your qualifications. And it rolls over to the next year. And on the next year, you get more depreciation added from the property itself, because it's not all of it up front. It's a big portion of it up front, and the rest of it is spread out over year over year over year. So no matter what, every year you're getting depreciation. This is just one way to front load it all.
Mm-hmm. Absolutely. Yeah. And so I know when we did our cost segregations in 2022, we got 100% bonus depreciation, but then with Biden in office and everything that's going on, that's changing a little bit. Do you want to talk about what's going on with politics and the cost segregation?
Let's talk politics. No. So one of the things that they put in that Tax Cuts and Jobs Act of 2017 was bonus depreciation. 100% of it, 100% bonus depreciation was from 2017 and ended December 31st, 2022. But the bonus depreciation didn't end, just the 100%. 2023, any commercial real estate property placed into service between January 1st and December 31st, 2023 is eligible for a max of 80% bonus depreciation. So it dropped 20%. And now we're in 2024, it dropped another 20%. But one key that I always want to mention, I always make people smile a lot more when I say this. It's all about the date the property was placed into service. If this is the first time you guys are hearing about cost segregation and you're curious if your property qualifies, you come and tell me, hey, Brian, I bought my property in 2019. I've been doing regular depreciation on it. I would tell you, well, you can now take that property and make it 100% bonus depreciated because it falls in that window of time, that window of eligibility. So now it qualifies for 100%. And now that's what you could get on your 2023 taxes or 2024 taxes, whatever filing you're in right now. And then we get to the fun part. So,
and then there's more.
So one of the things, I don't know if everybody's probably, watching the state of the market and everything that's going on. One of the things you've noticed, like in 2022, how hot the market was, how many deals were flying left and right, sales buys, everything. So it was going straight up. That was the last year of 100% bonus depreciation. Now, 2023, it dropped to 80%. And notice what the market did. It kind of teetered and started going down, right? Mm-hmm. Now, here we are in 2024. And we're still, it might be starting to, stay level, but it's still kind of dipping. Well, government is starting to realize, well, hey, we've noticed that the trend is this bonus depreciation thing. So as of now, there is a bill that's out there that it just passed through the House. It was mostly the Democratic vote that pushed it through the House of Representatives and is now sitting with the Senate. And then right after that, it goes to the president to sign off on it. But it is a bill that's going to restart 100% bonus depreciation, and it's going to make it go all the way back to January 1st, 2023.
Oh, wow. Really?
Yeah. Oh, yeah. So if that happens, not only it will restart that 100%, which is going to make that market go and go straight back up. My prediction. It's also going to add 20%, 40% of extra depreciation on everybody that closed in 2023. So that's the cool part.
That's incredible to hear.
Oh, yeah.
And then, I mean, in a sense, they're kind of just pumping it a little bit up again. So they're like, all right, well, the values are in. So, if it wasn't a good time to buy, I mean, definitely worth considering now. All right, well, let's
Oh
get in
no,
there and take advantage of this.
absolutely. But mark my words, and I'll say it right here on camera and on video and everything. When this does get passed, and it will get passed, watch the market go right in line with it over the next
Mm.
6 months.
That was my next question for you. I mean, obviously this has something to do with it, but big picture with what's going on in the market. I mean, where do you see things for real estate in general in 2024 and maybe 2025?
Oh, sure. What's interesting, and I'm in the market. I promise you, I've seen it all. Lately, it's seen that multifamily is taking a hit, but what I've seen a lot more, like kind of included now, are short-term rentals and single-family portfolios. But the big one is developments right now are going nuts, especially self-storage developments. Self-storage developments are just going. I'm getting them left and right, guys. It's you can still do cost segregation and depreciation on developments in general. The idea is take the losses when it's actually placed in a service or you've got a certificate of occupancy, and just move on from there. You can take those losses and distribute them however you feel you need to. But yeah, those are the big ones I'm seeing right now. A lot of conversions too. I take it back. A lot of like the mom and pop hotels, like the older hotels that are sitting out there not doing a whole lot. I've seen a lot of people buying those and converting them to multifamily.
Mm.
That's a big one right now too.
Okay. Do you feel like there's good opportunity in one sector or another, or kind of if you're placing your bet out there in the market, where do you see the most benefit?
Um, you know what? I gotta go with self storage right now.
Mm.
I see the returns are extremely high. The numbers are very good. The returns depreciation is extremely decent on it, and there's always room for development. Every single self storage that you buy, even an acquisition, there's always going to be land to develop more on it. So it's just that's how you get that additional revenue. It's not about, if for multifamily, for instance, if somebody moves out, or not somebody moves out, you make a classic unit a premium unit, there's that length of time. Well, with self storage, if you want to upgrade it, you just sweep it out and resell it.
It's a lot quicker innovation
Yes, it
process for
is.
self storage. Absolutely.
But
Yeah, and operationally, I mean, they run a little more effectively. You don't have a whole lot of toilets break in. You don't have heaters, and I mean,
that's
maybe you
right.
have HVAC systems for those on the premium ones, but there's just not as much that goes on. People aren't using them every day. They come by once a month.
Absolutely. And it's funny. I recently did a site tour for a self storage, and it was an unmanned self storage property. And that's the craziest thing I've ever seen. Completely unmanned. Everything was electronic to get in, electronic to scan your fingerprint to be able to access like the inside units. It's nuts how AI is making this actually work for their advantage. And the cool thing about it is all the electronics, all 5-year property.
Absolutely, yeah. Well, that's cool. Yeah, just
Yeah.
another benefit there. Well, I tell you what, we're kind of getting to the top of the show here. So just, is there anything else that you think people need to know about you and about everything real estate?
One of the things, like in particular with what I do, cost segregation, guys, it's never think that your property is too old, too dilapidated, is too new. There is no such thing as wanting to know, is it worth it to do it? And that's so from Ryan. What Ryan knows, what I do, I always like doing an estimate, like free way of saying, guys, let's see if it's even worthwhile to do it. All right. And I'll look at any type of property. The only thing I ask is at least in 6 figures or more. I've had a few wholesale ones that's not working out too well, but
Well, and I've
um,
sent you so many. I've sent you quite a few of those free estimate ones.
oh yeah, absolutely. And it's one of those things. I love doing this stuff, and I love talking strategy, real estate strategies. I've done every type of investing you can think of, from 401k to IRA to life insurance investing. I mean, you name it, I've been around the block. So
Absolutely. And I know I've had a lot of just my investors in our deals that just didn't believe that this was a thing, and I had them call you so that you could explain it to them, just like you're doing here. So it's just another value. So I mean, I would say, yeah, if anybody wants to reach out and find more information or ask you more questions, what's the best way for someone to get a hold of you?
Oh gosh, call, email, text. Connect with me on Facebook, LinkedIn, you name it. I'm one of those guys. I love talking about it. So just look me up.
Sure. Just your name, Brian Bigham, right here. Just like
Yeah.
type that into the Google is best way to do it.
Funny thing is that Cost Seg Cowboy. I was telling you that's kind of a brand that was given to me. That's actually my handle across the board on social media: Facebook, LinkedIn, Instagram. I think whatever is out there for kids nowadays, TikTok. You won't see me dancing videos, but I don't know. Maybe you'll see.
Excellent, excellent. Well, I mean, this has been wonderful, very valuable information. I know when we first met, I learned so much talking to you. I'm so glad that this is a real thing. I'm excited to not have to pay taxes again for a while,
Damn straight.
and glad that we can share this information with everyone tuning in. So again, Brian, thanks so much for coming on the show. Appreciate you having you. And everybody, if you haven't reach out to Brian. He'll save you some money on your taxes through cost segregation. So
Thanks,
thanks
Ryan.
so much.
Appreciate it. Thanks, man. Appreciate you.